This is the Definitely Uncertain podcast, brought to you by Goldrock Capital. Each week, we look at how high net worth families can improve their lives, decisions, and investments in a deeply uncertain world. We always aim to provide practical information, even if we can't offer specific investment advice. Welcome, everybody, to this week's episode of Definitely Uncertain podcast. My name is Darren Rockman, and I'm a partner at Goldrock Capital, the 20-year-old multifamily office servicing high net worth families in Israel and around the world. And this week, I am pleased to have on Definitely Uncertain, Sam Vecht. Sam, welcome to the show.
Hi, good morning.
Good morning to you. Sam is a fund manager at BlackRock, where he looks after emerging markets, and that's his area of expertise. Sam's been at BlackRock for 20 years and really understands this part of the investment universe. And what we wanted to do was to take a bit of a dive into the world of emerging markets today. So, Sam, let's start with this. Personally, how did you get involved or interested in the world of emerging and frontier markets?
Yeah, just before I kick off, just to say everything I'm going to say is not investment advice, and I'm speaking in a purely personal capacity and not reflecting the broader views of BlackRock. With that,
but that's okay because you're personally very smart, so we're happy.
Well, you can't be sure of that. You can't be. In fact, my wife would disagree. How did I get into this job? By mistake. Everyone likes to sort of say that they had some great plan age 3 to do something. That's not the case. I applied to lots of places when I was 20 in my second year of university. I think I applied to 45 places and I got one interview for a summer internship. So I'd love to say this is a very strategic, deliberate career path. It wasn't, depending on your view, it was random, an act of God, or something else. So you take your religious viewpoints for yourself.
Literally the random walk down Wall Street. Okay, so let's now switch to the sort of subject matter. Emerging markets and frontier markets. You know, when we look at the investment universe at the moment and we look at what's going on in developed markets where, you know, it's very clear that valuations have gotten very stretched. It's very hard to find pockets of value, and arguably some sectors, even many sectors, are in a bubble. How do you see the emerging market world and the frontier market world? Because it behaves quite differently. Yeah,
I think actually there's some commonality there. So that while you have large sections of the emerging market world where things are actually really cheap, you can buy stocks, on 5-7 times earnings in lots of countries and lots of sectors, and we can come to that in a second. There is a significant portion, and perhaps the most liquid portion of emerging markets today, which has many of the attributes that you described to the developed world. So stocks that have no earnings, often no operating earnings. Trading at very lofty valuations, very high market capitalizations, big values ascribed to pitch books rather than to net income.
Right. In the developed world, that's being generated by ultra low interest rates and really money looking for some type of return. Is the same thing happening in those more expensive parts of the emerging world?
Yeah, the same sort of driver. And I'll just add one other driver. Yes, it's low interest rates. And I think that the phenomenon is not just sort of an institutional phenomenon. It's also people stuck at home with nothing to do. And that's true in all countries, or in many countries over the last year. People's incomes have not necessarily collapsed. People perhaps getting handouts from governments, but their spending has gone down because they can't go on holiday and they can't go to restaurants and lots of things they can't do. And so what do you do with that, as it were, spare $1,000, especially when your next door neighbor has just doubled their money on the latest hot tip that he heard from his next door neighbor. So there's been a surge of, let us say, lower quality investing globally in the US and emerging markets too.
And so how is that translating into fund flows into emerging markets?
So what you're seeing there is, emerging market fund flows have picked up a bit. I mean, they've been at a multi-year sort of low level in sort of 2020. If you think about it, emerging markets have underperformed for most of the last 15 years. Emerging markets hit an all-time high in October 2007 and only actually regained that level a month ago. So after 4,500 days in a sort of bear market, these markets finally regained where they were just shortly after Tony Blair was the UK Prime Minister. I was going to say,
Tony who?
Tony, exactly. No idea who he is. So it's really quite interesting. That's true in emerging markets. Obviously, in the developed world, for much of the last year, the S&P, Nasdaq's hit new all-time highs every third day. So it's a very different outcome over recent years. That said, in the last 6-9 months, money has come into emerging markets, but all of it, or the vast majority of it, chasing exactly the same themes, dreams, stories, and pitch books that's been chasing the developed world. The charity sector, as I like to call it, the not-for-profit sector, has been sort of the leading place that's attracted flows. And, the greater the losses, the better.
And you're talking about mainly technology-driven companies on a growth binge, not making any profit.
Yeah, I mean, you can call it technology. I mean, it's technology in a very broad sense. I mean, some of these companies sort of only connection to technology is that they have an IT, they have people employed in IT. Not that they've only got great technology behind them, but anyone that can just, almost, I say it sort of flippantly, but almost anyone that can sort of say we're burning lots of money really quickly. That's been a greater attribute for companies in the last 6-9 months.
Okay, and you're seeing this in China. Where else are you seeing this happen?
You've seen it in China. You've seen it in Brazil. Those would probably be. China is clearly the dominant feature. You see it in Korea and Taiwan to an extent, but China, Brazil, slightly less extent in emerging Europe, and also, interesting enough, to a lesser extent in India. Indian market, although it's gone up, has actually been driven by something called fundamentals, like earnings. And sort of an economic cycle. I know, strange concept. India's, interesting enough, has been probably the most fundamentally driven market in emerging markets in the last year. But many other markets, but China's been the dominant one. If it's got losses, it goes up.
Right. So now you're sort of painting a picture of sort of two sectors. Let's move away from the expensive and, maybe unjustifiably expensive sectors, and let's start to talk about those areas where you think there is actually traction and value and a reason to invest.
Yeah. So I think it's interesting, and we don't know why, but COVID has not really hurt the emerging world, and I'm talking sort of medically and economically, to the extent one that was forecast sort of 9-12 months ago, or to the extent that one would think relative to the developed world. So, we don't know what's going to happen in the future, and perhaps there'll be new variants, but across the emerging world, what has been surprising, and, you had different ways of dealing with the virus. In China had one sort of a big lockdown and sort of punishing strongly people who didn't sort of keep to that. Korea's had a slightly different approach. Africa, was kind of a completely different approach because, haven't had real lockdowns. India had a lockdown for a few weeks and then they haven't really had a lockdown. Across the vast majority of emerging markets, and I stress this is for reasons we don't know, the number of deaths has been way lower proportionately to what we've seen in the US, the UK, and perhaps it's younger population, perhaps it's vitamin D, perhaps it's BCG injections. I mean, we have no idea. There's lots we don't understand about COVID, but the general point is COVID has been less significant economically than one would have thought.
Okay.
And therefore, what that means for investments is that we're having a pretty sharp recovery in many of these countries from sort of the economic slowdown quicker than we've probably seen in the developed world. And therefore, cyclical sectors that benefit from this, should do well. And, whether you're looking at banks or other banks, industrials, cyclicals, transport, lots of different things like that, should bounce. If there's any connection between share prices and earnings, then these sectors should do fairly well.
Okay. And these sectors, how have they performed over, say, the last 6 months where you've seen, emerging markets start to come back into vogue after many, many years of being sort of like, that's where I went to lose money?
Yeah, and may still be where you go to lose money. But they've bounced. But it's interesting when you look at emerging market returns, in 2020, the top 4 or 5 stocks made up 150% of the return. Not just sort of 60 or 70%. The top 5, 6 stocks, they were all the return. So the things have bounced off extremely low levels. At points in March, April last year, Brazil was back to where it was in sort of 1995, I think, and Poland and Russia. I mean, you had a whole collection of countries that were back, to levels that were seen first 15, 20 years ago. And clearly the countries with all their problems have developed quite a lot over that period of time. Right. So yes, you had a bounce, but it's a bounce from really, really depressed levels.
So that begs the question, which is why were these markets at such depressed levels, and why did they stay there so long? And I suppose the corollary to that is it different this time around?
Yeah, fair point. I think, going back to where you started, in a low interest rate environment where people have lots of money to throw at things, they try and work out what should I invest in. And a lot of that's just been a function of whatever's worked until now. And, why on earth should I invest in diluted appropriate Latin America, emerging Europe, Asia, with all these funny countries with risks and political challenges and coups and crises and capital account problems, when all I need to do is own a NASDAQ ETF, and that gives me, a solid 20% every year. Every year, no problem. Close your eyes. Some years 40%. So, and I think that's the real question for many people. On the one hand, you've got high volatility and lower return associated with emerging markets. And on the other side, just buy the US, then you've got lower volatility and higher return. It's kind of a no-brainer unless one understands how finance actually works.
Okay, so that's generated a sort of shift towards the developed markets, and particularly the US, at the expense of other markets. Now what?
Yeah, so I think we've got to ask ourselves the question, is 2021 like 2020? And is the portfolio that did well for people in the period 2017 to 2020 the right portfolio for 2021 to 2024? I would argue that a world with Biden rather than Trump, a world with vaccines rather than no vaccines, a world with a weaker, I wouldn't say weak, but a weaker dollar rather than a strong dollar, and a world where there's going to be a lot more focus globally on fiscal aspects of spending. And a world where tax rates may well be going up in lots of the developed world is a very different world to what we saw in 2020, or indeed the world we saw 27 to 2020. And I think those are quite significant developments, slightly more, slightly less in different countries, that are worth paying attention to as to why 2021 to 2024 does not equal 2017 to 2020.
Okay, so I want to pick up on a comment you made about the US dollar. So we've seen some dollar weakness over the last, back into sort of the middle of last year. That seems to be continuing. We had recent comments by the Fed, which obviously will put more pressure on the dollar. How do you take that into account when you think about emerging markets? Obviously, a weaker dollar is good for emerging markets.
It's good, but I think it's 2 points. Number one, when one invests in emerging frontier markets in general, I mean, the golden rule is if your local currency goes down 10, the market goes down 20 and you lose 30, and that happens in a few days. So there's no investing in emerging markets without taking into account the role of the currency, fixed income, and politics. It's a complete nonsense. I've got great returns in Kwacha. Well, who cares? Right? Our investors, your investors are all, at the end of the day, looking at hard currency returns. Yeah. And so it's really important to say that. That said, you don't need the dollar to collapse for emerging markets to do well. All that you need is it doesn't just strengthen a lot. It could strengthen a bit, just not strengthen a lot. I don't have a particularly strong view as to where the dollar's going. As you made sense from this podcast, I have quite strong views on lots of things, bar 6, and they are pound, dollar, euro, yen, oil, and gold. And that's because I'm yet to work out a way of getting that right, even 51% of the time. Those things.
You need to add Bitcoin to that list, don't you?
Well, no, that I've got a strong view on. That's easy. That's easy. I mean, how much is Bitcoin worth? I mean, I don't know. It's worth 2 Father Christmases, 3 Tooth Fairies, and 4 Orcs. It's worth whatever you like. And perhaps I shouldn't say Father Christmas on this podcast. It doesn't mean that much, but especially not before Purim. But seriously, back to the dollar. I have no strong view on the dollar. I would just kind of think that in a world where there's greater fiscal spending, and I'm not convinced the dollar greater US fiscal spending. I'm not sure the dollar strengthens that much.
Okay, So then when you're now constructing portfolios, what are, you talked a little bit about some of the sectors you're interested in, banks, industrials, transport. What are some of the countries which you think are best placed, over the coming sort of year or two?
Yeah. So it's interesting. Normally I could give you a couple of emerging markets I really dislike. There's this, people aren't pricing political risk in A or the currency collapsing in B. It's really quite interesting. Where we are today, I really struggle to find an emerging market I have a really strong dislike for. I think in some places, valuations are pretty compelling for the risk. And in other places, the story is actually quite good. So in terms of good stories, I think a place like Korea actually stands up quite well in terms of being neither China nor the US. So as tensions sort of increase there, people that manufacture in Korea can actually sell to both, which is an advantage. And we've just sort of seen Korea exports. I think they were up a ridiculous 20-25% year on year in January. I mean, it's a remarkable number. That's, there's always a Chinese New Year effect, but it actually works the other way this year, because last year, Chinese New Year was in February, and this year it has moved. So actually, it's sort of the reverse effect. So really big numbers out there. We've seen Taiwanese exports up 50%, but Korea strikes me as quite a good place, cheap valuations, good companies, not great corporate governance, but able to sell to both China and the US. India, Philippines, Indonesia, quite good domestic growth stories in a world starved of growth. There's endogenous growth in those places. I think the Chinese economy is doing perfectly okay, not superbly, but perfectly okay. And, if you're buying old economy sectors in China, there's some really, some really good valuations and decent, not great companies there. Then you can come across to the Middle East. And I think we can have a pretty strong recovery in a place like Dubai. It's been in the doldrums for years. You may have gone there recently, like half of Israel. But for those of us that have been going to Dubai for many, many years, long before it became the place to go, I think there's stuff to be said about the UAE and Qatar, for that matter. So they're pretty cheap for what you're buying there. Then you can come into sort of emerging Europe. Sort of Eastern Europe going to benefit from sort of handouts once again from the European Union. Greece, 15 years of recession now coming to an end. Stuff really cheap there. And then you can come across to Latin America, where, Brazil's got political issues, but a lot of that, again, for the domestic cyclicals, is in the price.
Okay. So basically what you're saying is when you look across the emerging market spectrum, other than a small group of sort of headline companies, mainly centered around China and Brazil, where there's just, it's a lot of fluff and just caught a disease, which is rife in the US. The rest of it looks pretty good.
It looks pretty good, but these are emerging markets. So every single day you wake up, we're sort of wondering, what's going to go wrong. It's not what's going to go right. Is, where is there going to be today's crisis?
Yeah.
And there's, most countries go 3 to 4 years without a crisis. Interestingly enough, if one sort of thinks about crises, the vast majority of Asia hasn't had a crisis since 2009. There's been no sort of domestic crisis, apart from 1 year, I think 2015 in Vietnam. But if you look at most of the markets in Asia, they've actually had 12 crisis-free years, which concerns me, because we are definitely due for a crisis in at least one of those countries. Most of the stuff in emerging Europe, in Africa, in Latin America has been, true to form. Every 3 to 4 years, something blows up in one of those countries.
Right. So let's just pick up on something that you mentioned a couple of times, which is this issue around volatility in these markets. So, when you look at the fact that you get these blow-ups and these sort of unpredictable events. What does an investor need to be able to generate out of an emerging market portfolio in order to make it worth taking some of the risks inherent in those markets?
Your cost of capital when investing in emerging markets should be higher. And woe betide the person that looks at a market that's in emerging markets and says, "Oh no, this is a safe place to invest." That's the most dangerous thing you can say. And in fact, whenever I see notes, a broker, so-called research notes that, increased visibility leads us to increase our target price, I always get scared because you never have increased visibility. That's just not how it works in the emerging markets or anywhere else. So the golden rule of emerging markets has been for 200 years. You buy to the sounds of cannons and sell to the sounds of trumpets. That was said about the Napoleonic Wars, and that's true today.
Right. Okay. So when high net worth, the high net worth individuals that listen to this podcast think about the construction of their portfolios, what's the role that you see for the emerging market piece? Because clearly no one's going to do 100% emerging markets unless somewhat crazy, suicidal, or both. But no, I shouldn't say things like that. I'm going to say that again. I don't want to upset anybody. Clearly, nobody's going to have 100% of their portfolio in emerging markets. But what is the role?
Yeah, so I think going back to the point I made earlier, the world is we're going to have an economic rebound now. After that, post-COVID, exactly, quickly in some places, slightly slow in others. But after that, where is the growth in the world? Where are you actually seeing countries that can grow on a sustainable basis without just leveraging themselves to the hilt? And it's going to be in emerging markets. And therefore, it's about having access to that growth at a sensible price. And that's a really important point. Time and time again, people that buy stories, themes, and dreams in emerging markets lose lots and lots of money. And that's the story of the last 25 years. So what's the role of emerging markets? To give you growth in a growth-starved world and do it at a sensible price. That's really important. But be aware there's volatility. So, the last thing you should do in emerging markets is you need to have a portfolio approach, asking which country should I back this year? Now, that's just not the right question, because sure enough, if you put all your eggs in whichever country it is, there's going to be a problem. There's going to be, it's the golden rule is that, when your mum comes to you and says, oh, yes, Sam, you work in emerging markets. I've heard some really good things about country X. It's time to sell. Right.
Has that happened recently, Sam?
It's absolutely happened. I don't want to defame my mother in public. She's a lovely lady.
I'm sure she is.
But definitely, when she suggested it was time to be looking at people making PPE globally, that was probably the top of the PPE cycle.
Right. So if we I want to just sort of round this discussion around volatility with one other question, and that is, one of the issues around emerging markets is that very often over the last, as we've said, the last 15 years or so, you've seen them trail main markets or developed markets. But then when the pop happens in developed markets, suddenly there's a even bigger sell-off in emerging markets because everybody just gets scared and everybody comes home. The same thing that we saw in March of 2020 when everybody physically went home, wherever they came from. The same thing happens emotionally with people's wallets. So how do you look at that?
An opportunity. Like, you just have to live through that, right? You need to be long-term and not freak out every single time this happens. I mean, this is, emerging markets go down 20% every single year. In the last 25 years, I think there's only been 1 year where top to bottom, during the course of the calendar year, emerging markets aren't down 20%. And remarkably, in that period of time, there's been not a single year where they aren't up 20% at some point, top to bottom. 80% of emerging market stocks move 40% or more every year. Right? So that's what you're playing. And you are living in a fantasy world if you think that you're going to get anything else and you can just buy this nice, stable collection of emerging markets. So you need to be, going back to the point you said earlier, you need to be compensated for that. So there are two ways really of getting compensated for that. It's either going to be lots of earnings growth or multiple expansion. And people, have different views on this. Some people think, you buy a stock at 100 times earnings. It's a very good idea because it can go to 200 times earnings. And that's kind of been the views of people in recent years. I don't think that makes a lot of sense. So that's what you need to be compensated for. Long-term investing, not looking at a single country, not putting all your eggs in one basket and being prepared to ride the volatility.
Okay, so I think that the key words here are diversification, appropriate compensation, patience, and making sure you've allocated it right.
Yeah.
Okay. Well, Sam, that's been hugely interesting and engaging and also pretty funny as well. And thank you very much for joining the Definitely Uncertain podcast. And thanks, everybody, for watching. you can subscribe on iTunes, wherever you get your podcasts, and we're obviously available also on YouTube. And we look forward to seeing you next time. Thanks, everybody. Thanks, Sam.
Thank you.
Bye-bye.